depending on where you are. And thank you for joining us. For those of you who don't know or didn't see our announcement, we did move our office. We're now located near Buckley Road and Taft Road in what I call North Syracuse. It's actually Clay proper, uh, um, but just off of Route 81. We're temporarily located upstairs, but we're using the space downstairs for conference room and for most of Zooms. You can see today I chose to do it in the upstairs space, just so you guys could get a snapshot of the office behind me, and you'll see a little activity back there, but not too much. A lot of the team is on lunch. By popular request, we changed this meeting time, this commentary time, to 12 noon. I don't know if that worked out or not because we have about 50% of our usual attendance, but we are recording this. For those of you who chimed in, you probably noticed that it reminded you that this is being recorded. And with that, I just want to remind you that as I present, if you could please hold all your questions till the end, because we do have to submit this to compliance before we post it to our website. And if you're asking questions, most of the time they ask us to delete that portion of the presentation. This is all 100% done by me. These are all my opinions, slides that I've chosen over the course of the last handful of weeks to put together for the commentary. They are not the opinions or thoughts of anybody other than myself. You may share those, which is great. You may disagree, and that's fine too. As I do conclude today's presentation, I'm going to leave plenty of time for any questions and do my best to answer those. I'm going to dive right into it though. And as you can see, the title that I chose for today's meeting was Gloom, Doom, and Boom, Bold, Old, and Crazy Thoughts. And that's really just the way I kind of thought about it as I put together today's presentation. And I am going to start on the side of gloom. Maybe. There we go. All right. So if you know me well, you know that I am far from a pessimist. I tend to fit more with the cautiously optimistic. And I add the cautiously to my definition of self because I've always felt it necessary to have a cynical side. My intent today is not to instill fear nor greed, but to provide a glimpse at what is going on in my mind and the reasons behind those thoughts. No matter your interpretation of what I present today or any day, we'll always approach your portfolio with the knowledge that we do not know what the future holds, and therefore will maintain a well-diversified portfolio that is suitable to your personal situation. We will not invest in the past by identifying what did or didn't do well, but we will focus on the future and what has the strongest probability of performance based on our research and our experience. So that said, let's turn to the areas that I consider deserving of the title gloom. Gloom, by definition, is to look depressed. And when I look at the areas I'm about to discuss, that's exactly what I see. Keep in mind, depressed does not mean no hope. Let's start with the overall state of finances. Focusing on the chart on the top right side, we see the household debt service ratio. That number has certainly started to climb, but it's nowhere near what we were seeing back in the early 80s and through the early 2010s. So debt service as a whole is not as a concerning level. Remember, interest rates were quite high in the 1980s and up until about the year 2000 or so. With the American dream being a strong focus in the early 2000s, interest rates started to drift downward and underwriting efforts on mortgages grew far more careless at best. With all the financing that took place in the housing boom, we saw the debt service ratio swell to a whopping 13.2%. The decline in the debt service ratio happens to match up with the incredibly low interest rates over the last decade. While things are not bad considering history, we can see in the bottom chart that we have not seen those numbers inclusive of student loan paybacks in quite some time. With student loans kicking back in and interest rates climbing, the debt service ratio is clearly expected to rise. It's pretty early in the cycle, yet the delinquency rates for automobile loans and credit cards have increased pretty quickly, as we see here. While the concern for debt service ratios increasing is certainly real, so too is the reduction in excess savings as people continue to spend down the surpluses that they received during COVID. Here you can see on the top right, the excess savings rates that people have experienced. Now, the personal savings rate fell to a paltry 3%, as we see here, in 2022. And to be honest, far from what I expected, it's actually seen a slight increase to about 4.7% in 2023. That is still far below the 8.6% average rate that we've seen since the 1960s. Note that the savings rate was much higher than the current throughout the 1980s and the early 1990s when interest rates were quite high. As student loan repayments start back up and take wallet share, it'll be very interesting to see the impact on these areas. Chances are that we will see a substantial drop in personal savings rate, as well in the excess savings values that people have. I was not able to find a great slide on the student loan repayment impact any more recent than late 2022, which was prior to the additional repayment delays provided by the Biden administration. But this slide will serve the purpose if we simply extend down here the lower red dotted line to the end of 2023. The increase in student loan payments is expected to be over $35 billion. $35 billion. This emphasizes the point that I made a moment ago on the reduction of the personal savings rate and on household excess savings. Student loan debt is an amazing 6.5% of GDP and consumes a portion of personal budget for over 45 million Americans. The largest exposure in terms of overall outstanding value and overall borrowers is for those having over $40,000 of debt. And you can see those numbers here. These households will feel the greatest impact on their budget at the same time that they experience a large increase in housing costs, healthcare costs, rising interest rates, and so on. In regards to housing, as a percentage of median household income, the median U.S. housing payment has rocketed nearly 60% in the last 3 years, rising to over 43% of median income. Couple this with the return of student loan payments, and many people will be forced to decrease their savings, their spending on other items, or both. And this could also lead to increased pressure on wage growth. Looking more closely at the housing market, if you had a budget of $3,000 a month just a mere 2 years ago in early 2021, you could have afforded a home valued at about $641,000 at the average mortgage rate of 2.65%. With average mortgage rates having climbed to about 7.49%, that same $3,000 budget drops the value of the home you can afford all the way down to $426,000, or 34% less in a market whose price has continued to stubbornly rise in many areas. In the United States, you must earn a whopping $115,000 to be able to buy, in today's world, the median home. Based on the information that I found on census.gov, the real median household income in 2022 was $74,580, or $40,000 less than what's needed to buy the median home in the United States. Interest rate increases haven't seemed to hit the automobile marketplace as much as we might have expected. As a matter of fact, average used cars have increased from a recent low in early 2023. It's not clear how much of that change has been impacted by our friends at Tesla, but it is certainly not a good time to be a Tesla owner, but possibly a pretty good time to be a Tesla buyer. Take a look at this next slide on the price of Tesla vehicles. Shockingly, the average cost of a used Tesla has plummeted from its peak of $67,900, or by about 40% it's declined. Now, don't worry, if you bought the stock at the same time you bought your car, there's a chance you made up for the loss on that car with the increased stock price. We will save that Tesla stock discussion for another time, but what does come to mind with the Tesla stock is a famous Alan Greenspan quote, irrational exuberance. All right, let's turn back to overall finances. With the combined concerns that I mentioned, a considerable portion of the American consumer may be headed in the same direction as the US of A with regard to debt to income ratios. Note that with interest rate increases, we have seen a $2 trillion increase in debt in a mere 4 months for the United States. Considering individual income taxes make up about 50% of federal revenue, it seems the ideal place to turn. In addition, increased Treasury sales seem all but certain, and those will be at higher interest rates, compounding the impact on U.S. debt servicing costs. With the cost of national debt climbing due to interest rates and spending, and given that the U.S. government's primary source of income is taxes, I happen to be in the camp that taxes need to increase. As a matter of fact, conveniently, the current tax code is set to expire at the end of 2025, and at that point, we revert back to the 2012 tax code. Here we see that the interest expenses has ballooned to $883 billion for the trailing 12 months on U.S. debt. Taxes are primarily collected in two ways from individuals like you and me: estate taxes and income taxes. Estate taxes are paid by the wealthiest people in our country, currently defined as those over $12.92 million in 2023. Now, if that person's married, then the 12.92 million applies to both spouses. So wealthy families that plan properly can actually leave about $26 million to their heirs without any estate tax. In 2026, that number drops down to 7.11 million, or a reduction of just over $14 million for a married couple. The result for wealthy families is an additional tax of about $5.4 million. I don't know what to expect with regard to the tax code expiring at the end of 25, but most of us are not too concerned with the estate tax, even if it drops to 14.22 million for a married couple. Income taxes, however, are a different story. The tax code change will impact pretty much every one of us, with the result being higher federal income taxes at the same taxable income level. In this analysis of a married couple filing a joint tax return, a couple that's making $150,000 can expect to pay about $5,200 more in taxes, while a married couple who's making $450,000 can expect to pay $22,700 more in taxes. This will take a further bite out of the consumer discretionary income and the ability for one to continue to spend the way they are today. Remember, consumption is a major piece of economic growth, so it makes sense to be a little bit leery. Given these two examples, the reduction in excess income as a result of taxes alone is about 3.5% for a couple making $150,000 and about 5% for a couple making $450,000. Let's turn to doom. Turning to those areas that I think are worthy of the title of doom, the good news is that these are areas that do not fall under the traditional definition of doom, as they will not substantially impact many of us. And if these areas do impact us, it should prove manageable and or temporary. However, for the average American, these areas are considerably impactful. The expectations for interest rates to stay higher longer now reflects in the market expectation projections, and the near term presents with a continued increase in rates, while the longer term does reflect a decrease, but the decline occurs more gradually and flattens out at a higher than originally expected rate. Please know that these rates seem and feel high because of something known as recency bias. Our memories are short, and the low interest rates that we've experienced for well over a decade are not normal. Where we are today is actually in line with the historical average. Please keep this in mind, as we should not expect rates to return to what we recently considered to be the new norm. The real impact of interest rates has yet to be realized, and that impact, again, will be felt most heavily by those who have poorly planned their finances. In particular, those carrying revolving credit card debt. The current average rate is substantially higher than it has been for the last 25 plus years, and is expected to remain high given the previous slide. Couple this with the higher cost for owning a home, the need to start paying back student loans, and the increase in taxes. And I think it's clear that we need to anticipate much higher default rates on credit cards, as well as a climb in bankruptcies going forward. While average hourly earnings have been on the rise, it is not nearly enough to support the extra costs associated with those higher costs for owning a home, for taxes, student loans, credit card revolving balance costs, etc. And for this reason, I feel that there will be a continued and increased pressure on wage growth, particularly for the population in the lower and lower middle classes who will be most impacted by these cost increases. One more pressure that we all experience, and it would be a mistake not to mention. Additional pressure on the consumer's wallet will be healthcare costs, which continue to rise at an alarming rate. While I knew healthcare costs have increased dramatically, I had no idea until I found this chart that the increase has been nearly 300% over the last 20 years or so. Given the pressures on the American consumer in so many areas, I don't think we should be surprised if the discussion on healthcare costs heats up again and becomes a primary focus as we see an election year roll around. While I do see the concerns for higher interest rates, the impact on credit cards, wage growth pressure, and healthcare costs a substantial concern for many in our country, I am relieved that we work with you and your family, as we have always been diligent in the Monte Carlo analysis that we do for you. Our projections have always leaned heavily on the conservative side, taking into account the tax code change and assumed an inflation rate that is about 50% above the average inflation rate over the last 20 years. We have also been actively planning for the anticipated tax code, and that change assists us in many ways, including Roth conversions in today's world, non-qualified account tax management, estate planning, and asset location coupled with asset allocation in your portfolio. While these efforts do not reflect in your statements, eMoney, Wealthscape, or the performance reports that you see, they have a substantial and lasting impact on your overall financial success. A great piece put out by Vanguard reflects that very point. While many clients, investors, media sources, and industry professionals, including advisors, fail to realize the benefit of non-performance-based efforts performed by a select number of advisors nationally, Vanguard publishes a fantastic piece that reflects the value of an advisor delivering in these various areas. As a matter of fact, the estimated value of these deliverables being met exceeds an average of 3% per year to the bottom line. There are 4 areas of note: the order of withdrawals, asset location, pragmatic investing, and behavioral coaching. I'm going to spare you focusing on each of these areas, as you have all heard us refer to each of these areas in our meetings. However, if you would like any additional information on any of these, please do not hesitate to reach out to any of the CWM team members. Finally, we get to the more exciting part of today's commentary, the areas that we see as potential opportunities for you and for your future. Let's start with CDs. If history is any indicator, the peak of CD rates is near. While we have access to hundreds, if not thousands, of CDs from around the country for our clients, it is extremely rare that we place our clients' monies in CDs. There are many reasons for this, but the most important being that while you are capturing the CD rate, you are also locking in an expiration date for that rate of return. When you acquire a bond position, the yield that you are locking in continues for the duration of the time you hold the bond. In addition, the yield on bonds tends to mirror changes we see in CD rates. So as bond rates go up and down, so too do CD rates. And looking at this chart, in all but 2 instances, we see that the S&P 500, the Bloomberg US Bond Aggregate, and the US High Yield Index all handsomely outperform the CD in the 12 months following CD rate peaks. Given that CDs are historically a conservative stance in one's finances, it would really not be fair to compare the CD to the 2 areas that had underperformance, as those would be the S&P 500 in the year 2000, as we see here, and the US High Yield Index back in 1989, as we see here. If we focus on the Bloomberg US Bond Aggregate, represented by the dark blue chart, right here, here, in all of these time periods, we saw outperformance. I am of the very strong opinion that this will be the case looking forward as well. It is important to recognize that when you buy into a bond position that has a yield of, say, 6%, You receive that yield for as long as you hold that bond. In a CD, your yield expires at the point the CD matures, oftentimes coinciding with the point in time when the interest rates have fallen. And if that were the case, then the new CD opportunity at that point would be at a lower rate. And in most cases, buying a bond at that time would have a lower yield than at the beginning of the same time period. If you are considering a CD or you have a CD maturing, it is worth reviewing your options, as taxable and tax-free yields are very attractive at this point, as well as money market yields. Money markets offer more flexibility since you can take your money out anytime without penalty, while most CDs require a repayment of interest earned, sometimes even more than what you have earned since starting the CD, which could result in a negative yield on that CD. While short-term CD rates are attractive for the most part, the longer the term, the less interest earned. That is the case for bonds as well. As seen in this chart, we're at the peak of the 15-year range, which is represented by this gray area. We are at the peak of that 15-year range in yields for all time periods as of mid-October. Less than 2 years ago, as we see by the yield curve at the bottom of this chart, we saw a more traditional yield curve where the short-term rates were low, and the further you went out in time, the higher the interest rates became. While the current yield curve will not be around forever, it has clearly been around for all of 2023 and continues to persist. As the yield curve returns to normal, the renewal of short-term interest-bearing instruments, such as CDs, will be less rewarding than they are today. We have remained short on the curve in your portfolio and will continue to overweight to the very short part of the curve, primarily at this 7-year point and shorter. There's just no reward for buying anything out here on the curve. To give you a better idea of how attractive bonds are today, when considering the last decade, US and foreign bonds are quite cheap as reflected in their current yields versus the 10-year median. A high yield environment often does not bode well for stocks because you can own what is considered a less volatile investment, a bond, and collect that yield. For instance, on the municipals with a yield to worst of 7.3%, the incentive to buy stocks at a higher level of risk to gather that same 7.73% or higher return clearly becomes less enticing. The yield environment becomes even more attractive when looking at the capital market assumptions of most firms. To shine that light a bit brighter, let's look at Vanguard's capital market assumptions. Looking back over the last few years, Vanguard has made considerable shifts in the portfolio design, primarily with the reduction in US equities, followed by an increase in US bonds and international equities. Bond allocations have increased by over 17% to a whopping 33%, while domestic equities continue to be underweight versus international equities. So here you can see May of 2021, US equity exposure 22%, May of 23, 18%. International equities 33, a decline to 27, but a jump from 28% in US bonds to 33 in US, and international from 18 to 22. Now, this was from June 26 of 2023. And with interest rates having risen considerably since that time, I would suspect that the next report showing a further increase in bond allocations. Please note that this slide reflects the Vanguard asset allocation model optimizing time-varying asset allocation and is not intended to be used by all investors. Let's take a closer look at the muni marketplace in particular. The primary chart on this page shows the tax equivalent yield on a BBB, triple B, and an AAA, triple A muni versus the current treasury yield over the range of 30 years. Here's your triple B, your triple A, and here's your treasuries. The lower line on the chart, the treasury chart, is the treasury yield, which looks familiar from the yield curve that we saw just a couple of moments ago. Now, it's difficult to justify owning treasuries in the current environment when compared to AAA muni space, other than that the treasury is backed by the full faith of the US government versus a municipality or similar. Sliding to the chart on the top right, we find an interesting comparison of the net debt on the federal side versus that on the state and local side. This supports the idea of muni bonds over treasuries, in my opinion. A short and sweet summary of the last few slides leads to the idea that we could see a relatively strong bond market in the not too distant future for several types of bonds, absent those that are long on the curve. Turning our attention to our friends overseas. As we know from previous market commentaries, we feel that the opportunity continues to be strong for international equities versus domestic equities, aligning us with the vast majority of capital market assumptions distributed by major firms, including the likes of Vanguard, JP Morgan, and City National Rockdale. As we saw on the previous slide, 2 slides ago, Vanguard's model suggests a 50% higher allocation to international than to US equities. While we feel that's a bit aggressive, that is probably a reasonable projection for the next decade, given current valuations and dividend yields. Just not a position we feel makes sense to take immediately. This chart demonstrates nicely that there are periods of time that international outperforms and periods of domestic outperformance. The most recent domestic outperformance has by far been the longest, dating back to the 1970s. Standing behind the periods of outperformance is, in part, the value of the dollar. 2022 marked, as we can see here, the highest level of the US dollar versus foreign currencies in over 20 years. As that trend reverses, it removes a key headwind and the opportunity for ex-US equities to strengthen. Looking at the history following peak dollar valuations, we have quite consistently seen periods of time that international outperforms. The bottom line is that we could be early in the making of the rise of international equities. The value of the dollar is not the only reason international equities are well positioned. They are also priced quite cheaply versus domestic markets, as reflected in the left-hand chart you see here. Price to earnings discounts are near the second standard deviation. Right, here's the second standard deviation. Trading at a discount of well over 30% versus US equities. Meanwhile, the dividend yield up here overseas is trading at the second standard deviation as well, with about 1.8% additional yield in overseas markets versus US markets. Continuing on the international topic and focusing on the light blue diamonds seen on the chart to our right, the US markets are trading above the 25-year average price to earnings ratio, while most foreign markets are trading below, affirming the potential for more bang for your buck opportunities overseas. Profitability overseas has also seen significant improvement, recently passing the profitability of US companies as a whole. Closing out the discussion on international, I thought it would be helpful to see the valuations by sector for Europe versus the US, with the exception of industrials. We can see up here. Every single sector of the European marketplace falls well below the 25-year average in terms of forward-looking price to earnings ratios. I've been calling the rise of international for a few years now. And like anything, if you stick to your opinion long enough, it's bound to be right, or at least one would hope. But the US run has gone so long and so deep that it seems the smart money would be drifting toward international at this point. I have not yet come across a chart that reflects the smart money movements, but when I do, you can be sure that I'll share that with you. I want to just spend a couple of minutes on the US markets. We continue to experience a new run on the growth side of the market in 2023, while we have remained overweight in value in most of your portfolios. Last year, that overweight really paid off greatly, while this year has taken away a bit on the domestic equity results in your portfolio. There are many reasons that I feel this is temporary. On the left, we see one of those reasons. This chart reflects that when the chart line falls below the green dotted line, that value equities are cheap. And when it's above the green dotted line, growth equities are cheap. We are and have been in a market environment where growth equities are quite overvalued, making value investments cheap by comparison. Growth equities have really been led by just a handful of stocks. I think it makes this story even more interesting. The top 10 stocks in the S&P 500 have had pretty good results year to date, but they are also quite expensive versus their valuations dating back to 1996, being about 40% overvalued as reflected on the left-hand chart. And here's that summary right here showing you the average going back to 1996 versus the current, and about 142% of the 1996 to present value. The top right, again, reflects that those 10 stocks make up about 33% of the S&P 500 index. Here we see that number. So by putting $100,000 of your money in the S&P 500, those who feel they are well diversified are actually misled, because 33% of their money is in just 10 stocks. While those stocks may have served us well in the past, investing does not allow you to benefit from past performance, only future performance. One must take into account the risks of investing at such a high valuation and decide if they are willing to take the chances of continued outperformance at such high valuations that suggest the upside opportunity is far less than the downside risk. While these 10 stocks make up 33% of the S&P 500 in terms of valuation, they only offer 19% of earnings to the bottom line of S&P 500. Finally, while U.S. value is less expensive than U.S. growth, the category is actually valued at its 20-year average, as demonstrated by the bottom right chart, where we see the current price to earnings ratio as a percentage of the 20-year average at 99% for large value. So large cap value, as identified right here, is actually reflective of its historical value. From a valuation, by the way, large cap growth overall is overvalued by 33.4%. That's large cap value overall, not those 10 companies we were just speaking of. From a valuation standpoint alone, value presents more attractively than growth, but international presents far more attractively than either, as we saw just a few slides ago. One last interesting look at the S&P 500 and its top positions. This reflects the top 7 stocks of the S&P 500. Those stocks make up, at the time of this chart in late September, about 34% of the S&P 500's market valuation. On average at that time, those stocks were up about 50% year to date. Most of those have given back a decent amount in the last few weeks. The other 493 stocks in the S&P 500 were pretty much flat at that time. The top 7 stocks were trading at a price to earnings ratio of about 50. Now, if you owned a company and you were offered 50 times earnings, you'd be a fool not to sell that company. But if you were offered an opportunity to buy a company at 50 times earnings, would you be a willing buyer? In most cases, I suspect the answer would be no. By the way, what this indicates is that approximately 80% of the year-to-date S&P 500 performance returns as of the end of September were thanks to just 7 of the 500 stocks in the S&P 500. Okay, to summarize, I touched on 3 distinct areas of gloom, doom, and boom. Gloom is ever present, and depending on the effort to find something that worries you and or others, the list can be quite long. I chose today to focus on a few areas that concern me, yet they don't keep me up at night. Those areas include overall debt, not just the level of U.S. debt and the cost of servicing that debt, but also the significant tailwinds facing the consumer, in particular, those in the lower and lower middle classes. Those tailwinds include student loan payments starting to eat away at the budget of 45 million Americans, while simultaneously the cost of housing is skyrocketing, along with many other areas. My opinion is that this will lead to a widening of the gap between rich and poor, and more strongly define the middle class. Reduced savings, reduced spending, increased bankruptcies, and a longer work life is the potential result for many. Doom, on the other hand, would be those areas that do keep me up at night from time to time. While many of the concerns that I expressed in gloom are the result of choices that people make, those that fall in the category of doom are not choices that we make, but force changes that we must deal with. The higher interest rate environment and the expectation of that lasting longer will force many to pay far more for necessities or for previous financial splurges that were placed on a credit card with the intent of paying that expense off over a reasonable time period. With credit card rates rising so substantially, many are faced with extending the time period of payoff. The result is paying far more for that purchase than they originally intended. Health insurance, as I mentioned, is another area that keeps me up at night from time to time. How the average family can afford coverage in today's marketplace is beyond me. I do reasonably well, and I still cringe at the cost of the health insurance premiums that I have to see every single month. Since the year 2000, we have seen the cost of family healthcare premiums climb nearly 4 times the rate of inflation. Despite the gloom and doom that always surrounds us, it is vitally important to focus on the boom to get through the day. I'm sure my comments and thoughts on a few areas of boom were made clear. We are not buying CDs for clients, even though rates look attractive. We are doing, as we often do, the more difficult process of educating our relationships, including you, on the pros and cons of CDs and other investment options in your overall financial picture. Lazy money is no longer a necessary. Lazy money is no longer necessary. It's a choice, meaning that money that is earning pretty much nothing doesn't have to be so. That is now a choice, given that money markets can easily be had for over 5%. Bonds are reaching very attractive yields, making domestic stocks less attractive from a risk-reward standpoint. International stocks continue to be attractive and deserve strong consideration for overweight in the near future. Domestic value looks quite attractive versus domestic growth, but when it comes down to it, your team here at CWM will consistently look for opportunities to help you accomplish your financial goals. Before we turn this over to questions, I thought I would share with you 2 quotes of great value. Habits are hard to give up, which is why they so heavily influence our future. Our financial habits are no exception. In many ways, we work to help you form and nurture good financial habits so that you can live a life of financial freedom. Habits are not formed in a straight line, and we will all regress from time to time. Getting back on track is not always easy. And discipline obviously plays a strong role. Having strong discipline is imperative to success in any area of life. And when it comes to the work that Custom Wealth Management does for you, we strive to be consistently disciplined through all the days of gloom, doom, and boom. Please be sure to join us in November as we have 2 really neat webinars with Jeff Lanza, who's a retired FBI agent, and he'll be speaking on the growing threat of cyber crimes and scams. More information will be emailed out to you very soon on that. But given the rise in scam phone calls and emails that I receive, and I'm sure every one of you as well, I'm pretty excited to hear what Jeff has to say. And I assure you, when you leave this webinar, you will have a new sense of confidence in helping to protect yourself, your family members, and friends from scammers. With that, myself and the entire team here at Custom Wealth Management would like to thank you, not just for taking the time out of your day to join us for this, but also for the opportunity to work with you and with your family. And with that, I'd like to open this up for questions that you might have. Just a note, for most of you, down on the bottom left-hand side would be the button to take yourself off mute. Please remove yourself from mute to ask a question, and then place yourself back on mute just so that I can answer without interference. And if you prefer to ask your question privately, you can do so in the chat button, and I'll repeat that question and not mention your name if you prefer I not. All right, so again, on the chat button, click on that and you can type in your question. So please take a moment to take yourself off mute if you have any questions, and feel free to ask away. Anything goes. This is your time. This is a first. I must have covered everything. Feel free to share any thoughts or opinions you might have as well. It doesn't have to be a question, but I always enjoy this open mic opportunity to hear from folks on what they're thinking or what might be concerning them. I saw somebody type John, but you didn't pose your question. Just be sure to type your entire question out and then push the little arrow on the right-hand side of the chat box. I see a couple people are on there. All right, we'll just give a couple more moments. And again, I want to thank everybody for joining us. We attempted to do this at 4 p.m. or we typically do this at 4 p.m., but we attempted noon based on feedback. We'll continue to try that noon time and see how it goes. Here come a couple of questions. Let's see. When you talk about international stocks, are you primarily talking about Europe or other areas of deeper interest? Actually, Europe is quite cheap, but so too are many other countries. So it is not focused only on Europe. There are quite a few areas of international exposure, including emerging markets, that are very inexpensive in today's marketplace. There are still areas that we will most likely avoid and tend to have minimal or any exposure to. One example that comes to mind is Japan, where I don't anticipate us having exposure, although, of course, that could change. Somebody just asked about regards to precious metals. So precious metals, let's use gold as an example. Most of our clients do have a core position in their portfolio called First Eagle. First Eagle is a great management team. And in that fund is where we have our gold exposure. Yes, that is primarily the only exposure that we have to gold, to commodities, to futures contracts. And the reason for that is a very, very, very difficult space to manage in. If you look at the average going back about 15 or 16 years, you actually have a negative performance over that time period. So one of the things I love about First Eagle is they will increase and decrease the gold exposure based on what's going on in the marketplace. We had a conference call with them just the other day, and they currently sit at about 15% gold in that fund. For most of you, that is reflective of about a 2% exposure, maybe slightly less than that, to gold in your overall portfolio. So we will not, and certainly plan on not having direct exposure to gold other than through that specific fund manager and potentially others depending on where commodities end up. But with a 15 or 16 year negative performance there, I think it's easy to see why we do not have exposure. Next, let's see. None of us have a crystal ball, but you have modeled things like the end of Russia-Ukraine war, Israel, etc. This is kind of hard to say, but if you take a snapshot of those two wars, the impact of those two wars on world GDP is actually quite minimal. And if they were significant, then you would see a significant impact. But the Russia-Ukraine wars, you're right in that they have exposure on some of the immediate surrounding countries, but we're not looking to index. And that would be one of the problems with indexing overseas is you would have exposure to a lot of areas that we would prefer not to. So active management and being very selective, not only of the active management, but knowing that the active managers are being very selective is the way that we feel makes the most sense to dive into the international side of investments. Both of those wars, unfortunately, are probably going to sadly last a long time. But we need to remain focused on the areas of international markets do provide opportunity because the war in itself, neither war in itself, means that international investing will suffer. Somebody just asked if college costs will increase. So I have a very strong opinion on college costs. I absolutely think they will continue to increase. But if you look at the last couple of decades of college cost increase, along with the increases has been an increased percentage of people who receive financial aid. So what's happening? I kind of refer to it as a voluntary tax. The wealthier Americans, defined actually at a really modest level, somewhere in the 150,000 of income range and higher, will ultimately qualify. People under that will consistently qualify for aid, and they'll qualify for more aid, while people over those income levels will continue to pay more and more and more to offset the cost of those who are receiving the aid. So just to reiterate, as the cost of college goes up, fewer and fewer people will be paying the full boat, but those who do will be offsetting the costs of those who do not. Hence, more people getting aid. Again, my opinion, my research, how I interpret it, but to me, that seems incredibly obvious from everything that I've read in the charting and all that I've reviewed on college costs. I've already told my kids they're not going where I went to school because it's about 80,000 a year now, and it just does not feel that just doesn't feel like it makes sense. All right, folks, thanks again for joining, and have a safe rest of your day.